So we have here with us today, Dan Friedman and Brian Beck. And guys, I just want to open this up and ask you the straight up question. What is the difference between tax planning and tax preparation?
The tax plan takes into account construction, tolls, and how to avoid them, accounting for things that have already happened, tax preparation, which is very important. No one wants to get a phone call or a letter from our friends at the IRS wondering why they've got information that doesn't add up on your tax return. There's significant complications to your finances if you don't square up on April 15th. So tax preparation is something that folks need to have a firm handle on. Tax planning, however, begins at January 1st of 2022 and then ends hard stop December 31st of 2022.
I'm sure, just like our CPAs, everybody's probably getting their letters from the people that do your taxes. Oh, look out for this, look out for that. You should be doing this, you should be doing that. And that's really not tax planning. That's a CYA, cover your ass, that you're actually showing your clients that you actually care about them and doing something.
It can actually be looked at every 90 days. And one of the things that we've been doing recently, at least in the third quarter, is looking at maximizing the opportunities that exist, taking passive tax losses with the decline in the market, and information and technologies leveled the playing field for what we consider middle-class millionaires, where you can go ahead and in a relatively short amount of time, using technology, take a loss, but still maintain your exposure to that sector, or even that particular stock. If it's healthcare, you can buy a basket of healthcare, take a loss, which is then deductible or offset against gains going forward. Also coordinating that for small businesses to maximize some of the tax benefits that are left over from COVID that are going to expire at the end of this year. Things like 100% deduction for equipment that you put into service.
Most tax professionals, you can't talk to from February 15th to April 15th. And then if you want to talk to them now, they're probably on the golf course if you're down in Florida, or the ski slopes. Now they got some snow out in the Midwest. But for us, this is the busiest time of the year. This is crunch time for people that really do tax planning. Tax planning really is picking up the phone, calling your client and saying, okay, if it's an individual, let's have an hour discussion. What's going on? Tell me about your cash flow. Send me your pay stub. Let's see what your year-to-date capital gains are. If you work for a public corporation, what are your options? What's vested? What's in the money? IRAs, should you be converting some to a Roth IRA? Gathering that information. And then a second phone call or a Zoom meeting like we're doing today to actually give actual ideas to say, this is what you need to be doing, not some 10-page letter you get from your CPA. Oh, here's 20 different points you should do at the end of the year. Well, how do I know which ones are right for me and which ones aren't? Because that's what a tax planner does.
What is that saying?
Taxes affect everything you do, and everything you do affects your taxes. And I think people subconsciously just watch the news and say, oh, that makes sense. With what went on in the last 6 months, one of the big things is, oh, I own Facebook or Meta, what it's called right now, or I hope you didn't own FTX and you lost all your money. So you're looking at things from the stock market perspective, and people aren't putting everything in. The account's down, like you said, Dan. Should I be converting to a Roth IRA? Should I not be? We talk about the double or the triple whammy, and really what that is everybody got hit with that a lot of people last year, which is what happened was in 2021, short story is that most money managers sold a ton of investments in 2021 in the first quarter because they thought COVID was coming back, and it never did. And the stock market raged on, and all of a sudden people ended up with, 30, 40, 50, hundreds of $1,000s of capital gains they had no idea that they were going to get. And all of a sudden it's February of 2022, they're getting their 1099s and they give it to their accountant. They say, well, you got a $150,000 capital gain. What? Yeah, you owe $30,000 in taxes. What? Oh, you didn't pay enough in. So guess what? You got to pay penalties, interest on top of that. What? Triple whammy. So you really want to avoid that, because right now for individuals, this is the time of the year you want to look at your statements, look at your capital gains, and we have the reverse of what went on last year. A lot of times this year, we have a lot of people that have losses. But if you needed to take money out of some investment accounts, some money managers, you tried to sell the winners and not the losers. So you may still have a capital gain. Do you? Don't you? Look at the numbers. And then if you do some tax loss harvesting to, draw down on some losses. And if you did own Meta and you said, you know what? I don't like them anymore. You know what? I'm just going to take the loss, and it's more than $3,000. You know what? You can carry forward those losses until you have gains in the future. So, now is the time really to look at the portfolio, rebalance. Some situations you should be buying, some situations you should be selling before the end of the year. And like Dan exactly said, 100% right. You can't do this in a silo. It's got to be a measured approach to you as an individual, irregardless of what somebody else is doing, your brother, your sister, your aunt, your uncle, your parents, your grandparents. It doesn't matter what they're doing, unless you're in a family trust with them, or a family limited partnership, or a business with them. You really have to plan based upon your own situation. And the biggest thing I could say, Brad, right now before the end of the year is just look at things from a logical point of view. Look at your tax return from 2021 and go down line by line and say, okay, are these changing? Are they going to be drastically different, either on the positive or on the minus, and deal with them either way? And there's some strategies before the end of the year that you can implement that will save you. And I always say, it's never one strategy that's going to save you, $5,000, $10,000 in taxes. It's a bunch of the little strategies that adds up and gets you to where you want to be and save the 5 or 10 grand. So we didn't get to touch upon that today. Dan, I think, briefly mentioned it. One of our real specialties is that we've been in business. I know it's tough to believe for most of you out there, 27 years. I think Dan was 18 and I was about 10 when we started it. But we've built up this network. I live in Florida. The main office is in Connecticut. We have clients in about 22 different states right now. So we have tax professionals, California, New York, Connecticut, Florida, all over, that we have not only worked, but more importantly, we have vetted to exactly, Jody, what your question is, that aligns with our information. Because a lot of times what ends up happening is we'll talk to a CPA and there's a blank stare on their face. And we know, okay, this is a person that just wants to do taxes, doesn't understand the coerciveness of doing a full tax planning strategy. And we could tell right away, when a CPA understands tax planning and what we're talking about, and ones that don't.